This is 2022, and 2022 was obviously a negative year. The blue line is the stock market volatility ending at a negative 20%. The red line is the bond market at a negative 15%. The benchmarks were somewhere in between, of course, and minus fees, everything's around 18%. Most of our portfolios did outperform that. The stock market being down is not an uncommon thing. It happens probably once every 3 or 4 years. We've seen it before. That's not a surprise. The bond market being down, however, is. And the first time that the bond market has had that sort of return since the late 70s, which means it's been 40 plus years since we've seen this. And a lot of people's concerns are like, well, what's the big deal with the bond market? Well, truthfully, as big as the stock market is, the bond market is 3 times larger. Okay, and so when we have that many assets going down in value, we definitely have a rough year. And I'll get into some of the reasons why. If we look at the markets from a 2 years perspective, this is the last 2 years of the stock market. You can see 2022 was down. In fact, the bottom was right about the end of September, beginning of October of 2022. At that point, from where we were, the market was down about 29% from top to bottom. Well, from January 1, I'm sorry, until October. Went down a little further than that from previous fall. But then we are obviously working our way back. We are not back to where we were in January before 2022, but we are working our way back, and it is definitely going in the right direction. Our concerns having to do with the equity markets especially have to do with recession fears. I'll talk a little bit about that. Have to do with inflation, and we've all seen that. I'll talk some more about inflation and interest rates. The way the federal government has been trying to limit interest rates or limit inflation is by raising rates. Over here, this is a world map. I know it's hard to see. This is a world map. The red countries on this map are countries that are in armed conflicts with either state forces or rebels or in a war, which means that you guys picked the right continent. I don't know. I mean, so we're in the right continent, I guess, is the point of that. And so anyway, we're going to talk about that. That is our main concerns. Now, so far in 2023, the first quarter, the blue line is the stock market. It rebounded pretty quick and then came back down and then started working its way back. And so that was the first quarter this year. The stock market was up. The bond market was up just a little bit from the end of the year, and that's during the first quarter. In the second quarter, the market obviously went up, and we did pretty well. The bond market was down just a little bit. In the third quarter, we had, which is our first full quarter since we changed to our platform to Schwab, and we had negative stock market and a negative bond market. And then so far since October 1, the stock market is on its way back, and the bond market is also positive. If everything holds up by the end of the quarter, your quarterly statements will be positive, which is that's a good thing. We like seeing positive returns. And so this is how the stock market and bond market has happened so far this year. This is a similar chart to the 2022 stock and bond chart, same chart. On the bottom is our exposure to stocks versus bonds. The green is our equity exposure. The red is our bond or fixed income or cash exposure. And so you can see that we had a very red-oriented year in 2022. In 2023, we've had a very positive or green-oriented year. And one of the things that kind of hops out at me when I look at this from a year perspective is the sheer volume of trading. And I'm getting ins and outs and making adjustments. The volatility was there to affect us in making a lot of trades in 22. 23, we haven't had to have as many trades. And actually, right here is about where we switched to the Schwab platform in the month of June. And so we haven't even had a lot of trades, but I will say since we've made the changes that our trade executions have been better. All around, everything is working better than in the past. And so I'm very, very pleased with where we're at with that. This is the dashboard. For those of you that have been with us for a while, when we started out with this program in 2016, end of 2015, we had 3 indicators, 3 red lights and green lights, and a lot of you have been shown that we've had the 3 red lights and green lights. We actually now have 10 red lights and green lights, except right now, all 10 of them are green. And so that is positive, and the 11th is alternatives, which is our gold exposure. So with that being said, our 100-0 portfolios are 96% equities, 4% gold, and a little bit of cash. Our 80-20 portfolio is 80% equities, 3% gold, and a little bit of bonds, and then 20% of bonds and cash. And then again, 60-40. And so the different portfolios have different allocations to stocks versus bonds. When we are green lights, this is as aggressive as it gets with the different portfolios. I'll explain in a minute some of the differences between the portfolios so that you have a better feel for how they work. From a leaderboard perspective, this is a ranking or a priority of the different things that we are largely investing your assets into. And so how to read this is the real estate and small blend investments are definitely not as positive as the NASDAQ 100 and the large growth at this point. And so as we are putting together the green equity oriented parts of your portfolios, we are concentrating up here in the NASDAQ 100 large growth, large blend, large value, the Dow Jones, and then basically the total market average. We try and keep everything above that. And so that is the orientation of your investments. Now, one of the neat parts about switching to a completely independent platform is that we as a team have 100% flexibility on the software and the technology that we have available to us and that we decided to use. And so now this is a new program that we have to be able to track how our investments are doing compared to benchmarks, or we can compare things. And so the history on this goes back to June 1 was the date that we changed our platform. The orange colored line here is the benchmark, and the purple colored line is the qualified 100-0, which is about 60% of the assets that we manage. So we have been basically outperforming the benchmarks since we got into this program, both up and down. What's also neat about this is that we can start looking at this in all of our portfolios, which I know this is hard to read, but basically the 100-0, 80-20, and the 60-40, all of them are outperforming the benchmark. The benchmark does not have fees. All of these returns in these portfolios are net of investor fees. So we are outperforming not only the benchmark, but we are outperforming it by the fees and then some. So we're very, very pleased with that. A cool part of this technology is that we get to, we can expand out and show some of our holdings. And so I don't expect you to be able to read some of these numbers here, but if you have $100 invested in the portfolio, roughly $6.85 is in Apple stock and $6.55 in Microsoft. We got $3.88 of gold. And then we've got $2 of NVIDIA, Amazon, Broadcom, Alphabet is Google, Meta is Facebook, Visa, again, some more Google, MasterCard. And so these are the top companies that we are investing in. There's actually over 1,069 investments. This is the top 15 or 20 of them listed here. So it is broadly diversified out from there. So for example, there is 97 cents out of $100 is invested in Pepsi. And Home Depot is 91 cents, and Chevron is 84 and 78, and it just gets smaller from there. So it is a very, very diversified portfolio. And so if you decided to sit at home on your iPhone ordering a Tesla that was advertised to you through Facebook, and you're trying to swipe it on Amazon, you are helping yourself out. Until you try and get that Tesla going in 20 below zero. I don't know. I don't have one, and I can't imagine. I don't know. Maybe it's great. I don't know. But this kind of gives you, my point is that we have a lot of new technology, and it is nice to be able to see how we're doing specifically. I believe that this chart will be infinitely more interesting when we've got 10 years of returns behind us. and we can focus in on the different time frames and such. We've only got returns for the last 6 months or 7 months or so. So it's it'll get better with time, but we are pleased. Any questions about the portfolios? Good. Long-term investing. We believe that the major concerns that we have has to do with inflation, interest rates, whether or not we have a recession, and geopolitical concerns. The government reported interest rate is 3.2%, and the government's calculations are how they come up with what inflation, I said interest rate, I meant inflation, is based on economics that was back, I believe, in the 60s and 70s is when they came up how to calculate inflation, and they haven't really changed it since. Truflation is a program that uses 10 million data points per day to calculate inflation. And so Truflation is, in my eyes, a better way. Apparently, the government can't just hop on this site and say, here's what inflation is. There's politics involved with things of that nature. But the government reported rate is 3.2. The current rate is 3.06. A year ago, it was 6.77. It did get down to as low as 2.05. The government's goal is to get it to 2%. What I have been noticing as I've been watching this Truflation website is that the government reported rate is basically just slower. It's higher than the actual inflation rates, which means that the government thinks that it's worse than it actually is, which is a positive from that perspective. So that is inflation. Now, when interest rates are high and the Fed wants to slow the economy, when inflation is high and the Fed wants to bring it down, what they do is they raise interest rates. And so 6 or 7, 8, let's see, 2, 4, 6, 8, 10, 11 times they have raised interest rates over the last 2 years, where we've gone from basically 0 to 5.5%. That being said, this is a historical chart on that going back to 1970. So you can see in the late 70s when interest rates were skyrocketing, and then since then they've been working their ways down. You can see back before 2000, and well, just to back up a little history, when we had the tech bubble in 2000, in 3 years the stock market dropped, the Fed lowered interest rates to try and stimulate the economy. Things were slowing down and we were in a recession. As the economy started to improve, they started raising rates, kind of putting gunpowder in the barrel sort of thing, so that in 2008, when we had the market drop and a recession take place, how they stimulated the economy was dropping interest rates back down to 0. And so with the interest rates being at 0, it took a long time to recover from 2008. They slowly started working their way back up until we had COVID, and they decided to drop interest rates right back down because they shut the economy down and worried about that. And that is now, and so this kind of gives you a graphical presentation to kind of give you a history on what's been happening with interest rates. Interest rates are important because bonds are interest sensitive, meaning if interest rates are going up, bond values are going down. If interest rates are going down, bond values go up. And the best way to picture that is, let's say you buy I'm just going to make something up, a Walmart bond for $1,000, and they're going to pay you 4% interest. If interest rates go down and all of the, well, let's see, let me go the other way. If interest rates go up and all of the new bonds that are being issued are 6%, what you paid $1,000 for, you got a loser only paying $4. To get rid of it, you might have to sell it for $900. The value went down. But if all of the new bonds are at 2 and you're holding a really good one paying $4, you could sell that $1,000 bond for $1,100. Does that make sense? So if interest rates go down, the value of the bonds go up. And so that is something that is reflective here. And again, that is really what's happened in the bond market, is that the Fed, with them raising interest rates, has hurt bond values. And like I said earlier, the bonds are 3 times bigger market than the stock market. Questions on that? They're doing this in an effort to keep us from going from into a recession, which is kind of interesting, because when people think of recession, everyone thinks, well, this is bad, except for all of you in this room who are invested in the stock market. Actually, a recession isn't necessarily bad if you're an equity holder, because the government is going to do things to try and stimulate the economy, which is better for the equity holder. If you're living in a job that can end, if you're living paycheck to paycheck with no cash reserve, a bunch of debt, and your job can be lost because of a recession, you have to worry. But for most of you in this room who have equities, a recession just means that the Fed's going to do things to help make the market better, which will help you in the stock market. So it's weird watching the news, hoping for bad news to make our markets go up. It's kind of weird, but that's where we are today. The last time I checked, I even read in the Bible that there's been a war going on in the world since the beginning of humans. And I have a prediction, it's not going to end. I'll move forward. Okay. That was my political. How'd I do? All right. You like that? All right. I thought this was an interesting chart. This just has taken the stock market for the last 70 years, and it's broken it down into the returns per quarter. So historically, the fourth quarter of the year has got the highest average return with an 80% of the time it's positive. And so 4 out of 5 times the market is positive in the fourth quarter by the largest amount. A lot of people have this misconception that like October is a horrible month. Well, actually the fourth quarter is actually the best quarter of the year historically for the last 70 years. Even the worst one is still positive 3 out of 5 years. It's positive in 3 out of 5 years and 3 out of 5 years. And so I thought this was an interesting chart, just letting people know that the fourth quarter is the best quarter. It's the Santa Claus rally and things of that going on. Now, last week I had a lot of time in the hospital, and I don't watch the news. I don't read the news. I don't look at the news and this kind of thing. But this got my attention. I don't know. They get you somehow. And it said that there was an extremely rare stock market signal with a 100% accuracy rate that is flashing and points to record highs in 2024. Now, if they want to get a guy's attention, that's how they do it. All right, so I had to read into this just a little bit. I don't expect you to read this at all, but what happened last week was 60% or 300 of the 500 biggest companies in the United States hit a 20-day all-time high. What's the big deal behind that? Well, the big deal behind that is since 1972, for the last 50 years, that has only happened 15 times, not counting this one. In all 15 of those times, 100% of the time, the stock market was positive 1 year later by an average annual return of 18%. So I'm saving you a long article read to let you know that, and then I got to also preface, and I got a slide here in a minute saying that the future is not always the same as the past. But if there was ever a signal that seemed positive or that had a 100% correlation is that it's happened 15 times. So if we are ahead 18% a year from now, we'll have brisket instead of chicken. I don't know what more I could do other than everybody's going to be happier. Maybe I should save the brisket for when it's down. And is that it? I don't know. All right. Anyway, so that being said, because of that, we are what it actually helped reinforce the idea that we are 100% green lights. We are 100% into the portfolios. We are 100% into our equities right now. And so then I saw that article, maybe even feel even better. What's interesting about that is about 60% or so of the assets that we manage is in this 100-0. And we've got some in the 80-20 and some in the 60-40. And the question becomes, why do we have these different portfolios? And it is because different portfolios have different time frames and you have different risk tolerances. And so the 100-0 will be a more aggressive portfolio than a 60-40. On a 1 being safest, 10 being riskiest, on average, our 60-40 is a good solid 2.5 to 3. Our 80-20 is 3.5 to 4, and our 100-0 is a 5 on a 1 to a 10 scales from a risk perspective. So even our most aggressive portfolio, because we are actively managing it, is considerably less risky than most portfolios that you had before meeting with us. And so that's something we like to point out. Now, if you're not sure what portfolio that you're in, because some people might say, all right, if I'm in this one and there's a 100% chance of an 18% return, historically speaking, maybe I would want to switch from here or from here up to here. It is okay to do that, all that you want. You just got to let us know if things have changed for you. And so we have more than the 3 portfolios, meaning we've got these 3 different portfolios for our retirement accounts. We have another set of 3 portfolios that act similar but trade less for our non-retirement accounts. And so that's 6. We've got 2 portfolios that are tax managed accounts that we use for our between roughly our 60 to 65-year-olds. If their income is important from a health insurance perspective, we don't want to create capital gains so that you lose health insurance credits. We have 2 portfolios for that subsector. We also have our Genesis accounts, which used to be 40,000 and below, now it's 25,000 and below. And those are, we don't, instead of investing in 8 different equities, we invest in 4 or 5 sort of thing. And so we've got quite a few accounts in that. And how they perform differently in the different environments is interesting to see. This is that chart that I had shown you earlier. And how this works is from June 1 to August, for the first 2 months, the 100-0 came up about 7%. The 60-40 came up about 3%. But then between August and September, when the market came down, the 100-0 came down less, more than the 60-40, and they ended up in the same spot. And we would anticipate that if we have a strong equity market where the markets are going up, the 100-0 should outperform a 60-40. If we have a negative market, this conservative account should outperform the 100-0. Does that sort of make sense? And so this is just some verification that that is what happens. And so if you're not sure which portfolio that you're in, what I want to make sure is that this workshop does not take the place in your mind of an individual meeting, because each one of you have individual needs and individual risk tolerances, and things are different on that perspective. And so again, my compliance officer said we can't say that the future is dictated by the past, which is true. But there is a few things that you can control. Your risk tolerance or appetite. You can control that, meaning out here on the interstate, if you're going 77 miles per hour or you're going 68 miles an hour with both hands on the wheel, that is your choice. It is a control, that is a risk tolerance that you have. Makes sense? Same thing can happen with your investments. Your time horizons, that can change. You had a cash reserve. You didn't think you were going to need the money. Something happened, some emergency happened, and your cash reserve disappeared. We might need to get to our investments if something happens again. Well, that means your time frames changed, which means that we can adjust your portfolios accordingly. Great Aunt Tilly dies, leaves you $500,000. We don't need this money for the next 10 years. That's a time frame change. Your behavior and your overall strategy is reflective. These are things that you can change. And so if I was to encourage all of you, is that when it is time for our reviews, whether it's a 6-month review, annual review, or anytime, anything that you have changes, contact us. We are here for you to help adjust your portfolios to make them line up with right in line with where you want to be. Any questions? We just finished dinner and it's nap time? Yeah. Jordan, any Zoom questions? No. All right. Okay, so Warren Buffett said the most important quality of an investor is temperament, not intellect, which means if you're dumb and patient, you'll probably do better than if you're really smart and impatient. I don't know. I thought it was a great quote. The other thing that I thought was kind of interesting is what we've got in common with Warren, big old Warren, is that he is the CEO of Berkshire Hathaway, and they have billions of dollars, whatever. Their number one holding, 48% of their portfolio is in Apple stock. Our number one holding in our portfolios is Apple stock. See, he's following us. He might be a little more aggressive than we are, but I'm going to invite Warren to come and speak at our next meeting. I don't know if he'll show. I don't know if he'll. We'll have to have brisket for that. All right, that's a thing. All right. So anyway, so I thought that was kind of a fun thing. So